Most people think opportunity announces itself loudly. It doesn't. The biggest wealth transfers in history happen quietly, while headlines distract and consensus stays comfortable. Right now, beneath the noise of daily market swings and short-term fear, a small group of forward-looking investors is doing something very different. They're not chasing what worked yesterday. They're hoarding what the world will need tomorrow. And before 2026 arrives, three assets stand out as the foundation of that future. The first is not a single stock, but an ecosystem, artificial intelligence infrastructure. Not the consumer apps everyone talks about, but the deep plumbing of the digital economy, advanced semiconductors, data centers, cloud platforms, and the energy systems that power them. We are at the early stages of a technological S-curve that looks far bigger than the internet or mobile revolutions. Training large AI models requires exponential computing power, massive storage, and reliable energy. Capital spending in this space is accelerating, not slowing, because productivity gains are too powerful to ignore. When productivity transforms, margins expand, costs fall, and entirely new business models emerge. Investors who understand this aren't speculating. They're positioning for a structural shift that will compound for years, not quarters. The second asset being quietly accumulated is gold, not out of fear, but out of strategy. When financial systems stretch under debt, when currencies are questioned, and when volatility becomes persistent, gold behaves less like a commodity and more like an anchor. Central banks across the world have been increasing their gold reserves, and that signal matters. It tells you that even institutions responsible for stability are preparing for instability. Gold doesn't need innovation to work. Its role is protection, liquidity, and trust. In portfolios designed for the next decade, it's not about betting on collapse. It's about balancing exponential growth with resilience. Smart investors understand that you don't build long-term wealth by ignoring risk. You manage it intelligently. The third asset is energy and critical commodities, especially those tied to electrification and next-generation power. Every AI server, every electric vehicle, every smart grid depends on physical resources: copper, lithium, uranium, and reliable base load energy. For years, these assets were underinvested because markets favored digital narratives over physical reality. That's changing. The energy transition is not optional, it's mandatory, and transitions of this scale don't happen without massive demand for raw materials and infrastructure. What looks boring today becomes essential tomorrow. When supply is constrained and demand accelerates, repricing is inevitable. Investors positioning here aren't chasing hype, they're aligning with physics and economics. What connects these three assets is not hype, fear, or speculation. It's inevitability. Artificial intelligence reshapes productivity. Energy enables that transformation. Gold stabilizes portfolios as change accelerates. These are not trades designed to impress on social media. They are long-duration convictions built on data, capital flows, and historical patterns. Most investors miss this phase because it feels uncomfortable. The narrative isn't obvious yet. The returns aren't immediate, but innovation has always rewarded patience. The biggest winners are rarely visible at the starting line. They're accumulated quietly, consistently, before the crowd understands why they matter. Before 2026, the gap between those who react and those who anticipate will widen dramatically. One group will ask why prices moved so fast. The other will already be positioned. History doesn't repeat perfectly, but it rhymes. And right now, the rhyme is clear for anyone willing to look past the noise and invest in the future as it's being built, not as it's being explained. Most investors believe smart money waits for clarity. In reality, smart money moves when things are still uncomfortable, misunderstood, and widely ignored. By the time certainty arrives, the opportunity is already gone. Right now, as markets argue about interest rates, short-term earnings, and daily volatility, capital that thinks in 5 and 10 Year Horizons is positioning for what the world will look like before 2026. And three assets stand out clearly if you know where to look. The first asset is artificial intelligence infrastructure, not the surface-level applications people get excited about, but the foundational layers that make the entire system work. We are entering a period where productivity is being redefined. Training and deploying AI at scale requires exponential increases in computing power, advanced chips, data storage, cloud networks, and specialized hardware. This is not a trend that pauses with market cycles. It accelerates because once companies see efficiency gains, they reinvest aggressively. The result is a feedback loop of innovation. Smart money understands that owning the infrastructure behind this shift is like owning the railroads during the Industrial Revolution. You don't need to predict every winner on top. You need exposure to what everything else runs on. The second asset being accumulated quietly is gold. This surprises people who associate gold with fear or pessimism, but this is not emotional buying, it's strategic. In a world where debt levels are historically high, currencies are under pressure, and geopolitical uncertainty is persistent, gold plays a unique role. It is liquid, it is globally trusted, and it is no one's liability. Central banks know this, which is why they continue to add gold to their reserves. Smart investors follow signals, not narratives. Gold isn't about timing a crisis. It's about owning an asset that holds value while innovation reshapes the financial system. When volatility rises, optionality matters, and gold provides that optionality. The third asset is energy and critical commodities tied to electrification and technological expansion. Every conversation about AI, clean technology, electric vehicles, and digital infrastructure eventually leads back to energy. Data centers don't run on optimism, they run on power. Electrification requires copper, lithium, rare earths, and reliable base load energy sources. For years, capital underinvested in this space because returns looked cyclical and unexciting. That underinvestment is now colliding with explosive demand. When supply struggles to keep up, prices don't move gradually. They reprice. Smart money sees this as a structural imbalance, not a temporary spike. This is about owning the physical backbone of a digital future. What connects these three assets is conviction built on long-term thinking. None of them depend on quarterly sentiment. They depend on inevitability. Artificial intelligence will continue to scale because it increases productivity. Energy demand will continue to rise because electrification is non-negotiable. Gold will remain relevant because trust and stability are scarce in periods of rapid change. Most investors wait for permission. They wait for headlines to confirm what has already happened. Smart money does the opposite. It looks forward, not backward. It asks what the world must consume more of, what systems must be built, and what assets protect value during transition. Before 2026, the market will reward those who aligned with these forces early. Not because they guessed correctly, but because they understood direction. Wealth is not created by reacting to the present, it's created by positioning for the future while it still feels uncertain. And right now, the future is quietly being accumulated. Most people think markets move on news. They don't. Markets move on innovation, capital flows, and inevitability long before headlines catch up. By the time everyone agrees that something is the next big thing, the real upside has already been captured. Right now, as we move closer to 2026, there are three assets quietly positioning themselves for exponential growth, and they sit at the intersection of technology, scarcity, and systemic change. The first asset is artificial intelligence infrastructure. Not the flashy consumer tools that dominate social media, but the foundational layers powering them. Advanced semiconductors, high-performance computing, cloud architecture, data centers, and the energy systems that keep them running. We are still early in this transformation. AI is not a feature, it is a platform shift that changes how every industry operates, from healthcare to finance to manufacturing. As productivity rises, companies reinvest savings back into technology, creating a compounding cycle of demand. The market often underestimates how long and how fast these curves run. Investors who understand exponential adoption don't wait for perfection. They position early, knowing that infrastructure scales before applications mature. The second asset being accumulated with intention is gold. This is not about panic or preparing for collapse. It's about understanding cycles. Innovation tends to bring volatility, and volatility increases the value of assets that preserve purchasing power. Gold has functioned as a monetary constant for thousands of years, and in a world where debt levels are high and currencies are stretched, its relevance increases, not decreases. Central banks are quietly adding to reserves because gold provides neutrality and trust in a fragmented global system. Smart investors don't see gold as competition to growth assets. They see it as a stabilizer that allows them to stay invested through turbulence while others are forced to sell. The third asset is energy and critical resources tied to electrification and digital expansion. Every AI model trained, every electric vehicle produced, and every smart grid deployed depends on physical inputs. Copper for wiring, lithium for storage, uranium and natural gas for reliable power generation. For years, markets ignored these assets because they lacked narrative appeal, but reality doesn't care about narratives. Underinvestment has collided with surging demand, and when that happens, prices don't adjust slowly. They reprice. Smart capital is moving into these areas not for a short-term trade, but because energy is becoming the limiting factor for growth. You can't scale a digital economy without a physical foundation. What unites these three assets is not speculation, but structure. They are aligned with long-term trends that are difficult to reverse. Artificial intelligence increases efficiency and lowers costs. Energy enables scale. Gold preserves value as systems evolve. Together, they form a framework for navigating a world moving faster than ever before. Most investors get distracted by short-term noise. They debate interest rate cuts, election cycles, and quarterly earnings misses. But wealth is created by focusing on where capital must go, not where it has been. The next few years will reward those who understand exponential change and prepare for it early. By 2026, these assets won't feel controversial. They'll feel obvious, and when something feels obvious, it's usually too late to capture the full upside. The real opportunity is now, while conviction is still required and the future is still being quietly priced in. Most people assume the biggest investment gains come from reacting quickly. In reality, they come from thinking differently and acting early. While the market debates inflation prints, rate cuts, and short-term volatility, forward-looking capital is already positioning for what the global economy will look like before 2026 ends. The real opportunity isn't where attention is loud, it's where conviction is quietly building. And three assets are emerging as clear long-term winners for those willing to look beyond the present moment. The first is the infrastructure behind artificial intelligence. Not the surface-level applications that capture headlines, but the deeper architecture that enables intelligence at scale. Advanced chips, high-performance computing, cloud platforms, data centers, and the energy systems that power them are experiencing an investment cycle unlike anything seen in decades. AI is not incremental innovation. It is a productivity engine that reshapes cost structures across every industry. When productivity accelerates, margins expand, capital is reinvested, and growth compounds. Investors who understand exponential curves recognize this phase as early adoption, not late cycle. They are loading up on the foundation before the full economic impact is reflected in valuations. The second asset being accumulated with intention is gold. This is not fear-driven buying, it's strategic positioning. Periods of rapid technological change often coincide with financial instability, rising debt, and currency stress. In that environment, gold serves as a store of value and a source of liquidity when other assets become volatile. Central banks increasing gold reserves are signaling something important. Stability matters when systems are evolving. Gold doesn't compete with innovation, it complements it. It allows investors to stay committed to growth opportunities while maintaining resilience through market shocks. Smart money understands that protecting purchasing power is part of compounding wealth, not the opposite of it. The third asset is energy and the critical resources that make electrification possible. Every conversation about artificial intelligence, automation, electric vehicles, and digital infrastructure eventually leads back to power. Data centers consume enormous amounts of electricity. Electric transportation requires massive quantities of copper, lithium, and other essential materials. For years, these sectors were underinvested as capital chased purely digital stories. That imbalance is now reversing. Demand is accelerating faster than supply can respond, and when that happens, prices don't move slowly. They reset. Investors positioning here are not speculating on scarcity. They are recognizing that energy is becoming the bottleneck of growth. Without reliable power and materials, the digital future simply cannot scale. What ties these three assets together is inevitability. Artificial intelligence will continue to expand because it drives efficiency. Energy demand will rise because electrification is non-negotiable. Gold will remain relevant because trust and stability become more valuable as change accelerates. These are not trends that depend on sentiment. They depend on reality. Most investors wait for confirmation. They want proof, validation, and consensus, but by the time consensus forms, the asymmetry is gone. The greatest gains belong to those who understand direction early and align with it patiently. This is not about predicting the next headline. It's about recognizing the structural forces reshaping the global economy. Before 2026 ends, the market will look very different from today. Some assets will feel expensive in hindsight, others will feel obvious. The difference between regret and opportunity will come down to whether you were willing to load up when the future was still uncertain and conviction still mattered.